Imagine you've done everything right. You showed up to work for 30 years, you maxed out your contributions, you watched your 401k climb from $50,000 to $400,000. You're 2 years away from retirement and you're finally feeling like maybe, just maybe, you figured this whole money thing out. Then a war breaks out on the other side of the world. And in 18 months, your $400,000 becomes $260,000. Not because you did anything wrong, not because you made a bad investment, not because you panicked and sold, just because the world decided to be the world. And now the retirement you spent 3 decades building is sitting there, cracked down the middle, and nobody on TV is telling you what to actually do about it. That scenario isn't hypothetical. It happened. It's happening. And if you don't understand the mechanism behind it, it will happen to you too. My name is Smith, and I spend way too much time thinking about how geopolitical chaos quietly dismantles the financial plans of people who did absolutely nothing wrong. If you're someone who's been contributing faithfully to your retirement account, but has this low-grade anxiety that something outside your control is going to blow it all up, hit subscribe and give this video a thumbs up, because we're going to talk about something today that most financial YouTubers are too polished to touch. Here's the thing. The personal finance world loves to keep things clean. Budget your money, invest in index funds, retire at 65, the end. And look, that framework isn't wrong, but it operates on an assumption that the global environment stays reasonably stable, that supply chains hold, that currency values don't get obliterated, that the companies inside your index fund aren't suddenly cut off from 40% of their revenue because of sanctions, trade restrictions, or a military conflict nobody predicted 18 months ago. We do not live in that stable world anymore, and your 401k was not designed for the world we're living in right now. Let's actually build the mental model here, because this is where it gets interesting, and most people never get this explanation. Your 401k is not a savings account. I know you know that intellectually, but I want you to feel it in your chest right now. It is not a vault where your money sits safely accumulating interest. It is a collection of ownership stakes in businesses. Businesses that have employees, supply chains, international customers, debt obligations, and exposure to the exact same global instability that shows up on your newsfeed every morning. When you contribute to a target date fund or an S&P 500 index fund, you own tiny pieces of Apple, Microsoft, ExxonMobil, JP Morgan, Chevron, Boeing, and hundreds of other companies that are deeply embedded in global trade, global energy markets, and global financial systems. Now here's what most people don't realize. The S&P 500, the benchmark that most American retirement accounts track, generates roughly 40% of its revenue from outside the United States. 40%. So when you hear that a conflict in Eastern Europe or a military escalation in the South China Sea is over there, what you're actually hearing is that 40 cents of every dollar your retirement portfolio earns is directly exposed to the instability happening over there. Let me give you a number that should stop you cold. During the 2 years following Russia's full-scale invasion of Ukraine in February 2022, the average American 401k balance dropped by over 23%, according to data from Fidelity Investments. The average account lost roughly $33,000. And this wasn't the 2008 financial crisis, where the recklessness was homegrown. This was a war on another continent between countries most Americans couldn't find on a map, and it reached directly into the retirement accounts of people in Tulsa and Tampa and Tacoma and took $33,000. Now you might be thinking, okay, but markets recovered. They always recover. Just hold on and ride it out. And historically, yes, that's been true. But here's the psychological trap buried in that logic. It assumes you have time. It assumes a 62-year-old watching their account drop from $400,000 to $260,000 can just hold on and wait 5 or 8 years for a full recovery. For a lot of people, that's not a market timing problem. That's a retirement destroyed. That's working until you're 70 instead of 65. That's selling your house. That's moving in with your kids. The math works in a spreadsheet, The math does not always work in a human life. Here's the mechanism. I want you to understand exactly how global conflict translates into your account balance declining, because once you see the chain of causation, you can't unsee it. Step 1 is energy. Every major military conflict in the modern era disrupts energy markets. When Russia invaded Ukraine, energy prices spiked violently. Brent crude went from $75 a barrel to over $130 in weeks. Natural gas prices in Europe went up by over 200%. Now you might think, well, I own energy stocks, so that's good for my portfolio. But what it actually does is create a cost shock that runs through every single company in your index fund. Manufacturing costs go up, shipping costs go up, input costs for agriculture go up. And when costs go up faster than companies can raise prices, profit margins compress. Compressed margins mean lower earnings. Lower earnings mean lower stock prices. Your account goes down. Step 2 is inflation. Conflict-driven energy spikes create inflation, and inflation forces central banks to do the one thing that is most destructive to stock valuations: raise interest rates. When the Federal Reserve raised rates from near zero to over 5% between 2022 and 2023, the fastest rate hiking cycle in 40 years, it didn't just affect the bond market, it changed the fundamental math of every stock's valuation. When risk-free treasury bonds are paying 5%, investors demand higher returns from stocks to justify the risk. Higher required returns mean lower prices today. And when you add the inflation erosion on top of the nominal decline, the real purchasing power destruction inside 401k accounts during that period was devastating for people within 5 years of retirement. Step 3 is currency. This one is subtle, but it's brutal. When global conflict escalates, money floods into the US dollar as a safe haven. Dollar strengthens. That sounds great, right? Here's the problem. When the dollar strengthens, the overseas revenues of American multinational companies, that 40% I mentioned earlier, are worth less when converted back to dollars. A company that earned 10 billion euros in European revenue suddenly books that revenue as $8.5 billion. Earnings per share drops, stock price drops, your account drops. This happened in 2022. The dollar index hit its highest level in 20 years, and it quietly carved billions of dollars out of S&P 500 earnings in a way that most investors never connected to the war happening overseas. Step 4 is supply chain fragmentation. This one is the slow burn one that most people underestimate. Modern warfare doesn't just destroy infrastructure in the conflict zone, it accelerates a process of economic decoupling that restructures global trade for decades. We watched it happen with China-US trade tensions. We watched it accelerate post-2022 with Russia's isolation from the global financial system. Companies that spent 30 years optimizing global supply chains for maximum efficiency are now spending billions to rebuild them for maximum resilience. Nearshoring, reshoring, duplicating production capacity. That is an enormous capital expenditure that comes directly out of the earnings that were driving your portfolio's growth. McKinsey estimated in 2023 that supply chain restructuring could cost companies between 2 and 4% of annual revenues over the coming decade. That cost is real, it compounds, and it sits inside your retirement account. This is where it gets psychological, and this is honestly the part I care most about, because the financial mechanics are almost secondary to what conflict does to human decision-making around money. There's a concept in behavioral finance called the availability heuristic. It's the brain's tendency to assign probability based on how easily an example comes to mind. When conflict is on every screen every day, your brain starts treating catastrophic financial outcomes as not just possible, but probable and imminent. And that's when people make the worst financial decisions of their lives. They sell. They go to cash. They lock in losses that might have recovered. Vanguard published research showing that investors who made panic trades during market downturns underperformed buy and hold investors by an average of 3% per year. 3% per year over 20 years on a $200,000 account is the difference between retiring with $440,000 and retiring with $1,020,000. Fear, compounded annually, is one of the most expensive financial decisions a person can make. But here's what I need you to hold in tension with that. Doing nothing is also a strategy, and it's not always the right one. The just hold on advice that dominates personal finance assumes a diversification structure that was designed for a pre-conflict world. The classic 60-40 portfolio, 60% stocks, 40% bonds, got absolutely crushed in 2022 because stocks fell and bonds fell simultaneously, which historically almost never happens. The reason they fell together is that the inflation shock from the conflict disrupted the normal inverse relationship between stocks and bonds. The diversification that was supposed to protect you didn't work because the nature of the risk had changed. Now look, I'm not here to tell you to abandon your 401k. I want to be very clear about that. The 401k is still one of the most powerful wealth-building tools available to ordinary Americans, full stop. The tax advantages alone are extraordinary. If you're in the 22% tax bracket and you contribute $10,000 to a traditional 401k, you're getting a $2,200 subsidy from the government on that contribution every single year. That math doesn't change because there's a war somewhere. What changes is how you think about what's inside the account. Here's what most people don't realize about their own 401k allocation. Most people set it up once, usually when they were hired and had no idea what they were doing, and they never change it. Vanguard's How America Saves report found that roughly 30% of participants in defined contribution plans have not rebalanced or changed their allocations in over 3 years. 30%! These are people who built a portfolio in a low inflation, low interest rate, relatively stable geopolitical environment and are now riding that same portfolio into a structurally different world without ever adjusting. Think of it this way. Imagine you built a house in 1990 in a place that was inland, dry, and safe. You built it to the standards of that environment, perfectly rational. Now the climate has shifted. Flooding is more frequent and the water table is rising. The house isn't wrong, it was right for its time. But if you don't make adjustments for the new environment, the house isn't going to protect you the way you need it to. Your retirement portfolio is that house. So what do you actually do? Let's get practical, because I refuse to spend 12 minutes explaining a problem without giving you something to walk away with. First, look at your international versus domestic exposure and understand what you actually own. Pull up your 401k today, not this weekend, today, and look at your allocation. If you're entirely in a large-cap domestic index fund, you're heavily exposed to multinational revenue risk through those 40% overseas earnings I mentioned. If you have significant international developed market exposure, you need to understand how currency fluctuation and geopolitical risk in those specific regions affect your holdings. Most people have no idea what they own inside their funds. You cannot manage a risk you can't see. Second, think seriously about your timeline and your true risk tolerance, not the imaginary one you answered on a questionnaire when you signed up for your plan. There's a rule of thumb that I think is still underused. For every year you are within 10 years of retirement, you should have a clear answer to the question, if this account dropped 30% tomorrow and took 5 years to recover, what is my actual plan? If your answer is, I'd be devastated and would have to delay retirement, then your allocation is too aggressive for your real risk tolerance, regardless of what any algorithm told you. The closer you are to needing this money, the more sequence of returns risk matters. A 30% drop in year 1 of retirement is exponentially more damaging than a 30% drop in year 20 of accumulation. Third, consider what assets in your overall picture are not correlated to global equity markets. I'm not telling you to put money in gold and sleep in a bunker. I'm telling you that real estate, particularly your primary residence if you own it, Treasury inflation-protected securities, Series I bonds, and even high-yield savings can serve as ballast in a portfolio that's getting knocked around by geopolitical volatility. The goal isn't to chase returns in every environment. The goal is to not be catastrophically damaged in the bad environments so you can still be in the game when things stabilize. Fourth, and I cannot stress this enough, Think about your human capital as part of your retirement picture. Your ability to earn income is an asset. Your skills, your professional network, your adaptability, these things have value that doesn't show up in your 401k balance, but that absolutely affect your retirement security. In an environment of geopolitical uncertainty, the people who fare best financially are not always the ones with the most optimized portfolios. Sometimes they're the people who kept their skills relevant, who maintained optionality in their careers, who had income sources that weren't entirely dependent on a single employer or a single market going up. Here's what this all comes back to. The 401k is still dead, but the passive, set-it-and-forget-it version of retirement planning that worked for the generation before you is being stress-tested in ways it was never designed for. We are living through a period of genuine geopolitical fragmentation, the unwinding of a global economic order that was built on assumptions of relatively free trade, relatively stable great power relationships, and relatively contained regional conflicts. Those assumptions are under serious pressure. That doesn't mean you panic, but it means you need to be a more conscious, more engaged participant in your own financial future than the old advice told you to be. The people who will retire with dignity over the next 20 years are not the ones who found the magic asset class. They're the ones who understood the risks they were taking, built structures that could absorb shocks, and refused to make the catastrophic emotional mistakes that volatile environments are specifically designed to trigger. They're the ones who picked up their phone, logged into their retirement account, and actually looked at what they owned. Most people won't do that. Most people will watch the market drop, feel that sick feeling in their stomach, do nothing because they don't know what to do, and then watch quietly as the retirement they imagined slowly morphs into something smaller, something later, something less. You don't have to be that person. The fact that you watched this video to the end already puts you in a different category. You're asking the uncomfortable questions. You're willing to sit with complexity instead of reaching for simple answers that feel good but don't protect you. That is the actual foundation of financial security. Not a hot stock tip, not the perfect asset allocation, not getting lucky on timing. It's being the kind of person who takes their financial life seriously enough to understand what's happening to it. So, go look at your 401k today. Understand your allocation. Know what you own. Know your timeline. Have the honest conversation with yourself about what a bad year actually means for your plan, and then build a structure that can survive one.